All right, in this video, I'm going to walk through 5 types of retirement income that's not subject to tax. So whether you're in your 20s, 30s, 40s, and you're still kind of figuring out retirement and what you're going to plan on doing, I'm going to walk through 5 simple, retirement types of income that once you reach that retirement age, you won't be subject to tax. If you have any questions, leave them in the comments below. And if you haven't subscribed to my channel, please do so. Thank you. Okay, so let's go through the 5 types of retirement income not subject to tax. So the first one is inheritance. If you inherit some assets, right? It could be, property, land, it could be investments, it could be cash. But, most inheritances are not subject to tax at the federal level, right? IRS. But every state has its own rules on how to treat inheritances. So I would check your state. Now, once you inherit that asset, so just say you inherit $1 million of cash, you put it in the bank and it earns interest, right? That future earning, that interest income in that example could be subject to tax, right? But that $1 million initially that you inherited would not be subject to tax at the federal level. The next type of retirement income is HSAs. So HSA stands for Health Savings Account, and it really has like a double benefit in terms of when you contribute to your HSA account every year, it's deductible, right? Those contributions are deductible. And then the earnings that grow in this account is tax-free. So you could put in, $5,000 a year to your account, and you start doing this at the age of 30, and at the age of 60, it grows beyond what you put in by another like $15,000. That $15,000 that it grew in addition to what you put in, when you take it out to be used for healthcare costs, is not subject to tax. So this account is a great strategy for, you may not need to use this now, but when you think about retirement, and especially those of you that are younger, you probably don't think about this, but healthcare costs are going to continually increase. And this is one of these accounts to have in retirement, because as you get older, there's more doctor visits, there's more medical bills, just a lot going on to your body, and you can utilize this account to kind of pay that off versus using it when you're younger. So the earlier you start this, the better. The third type of retirement income is life insurance proceeds. So if you're a beneficiary and unfortunately someone passes away and you're the beneficiary of that person, and you receive a one lump payment, and that's key, one lump payment versus payments over 24 months or over 10 years. So if you receive a one lump payment, that those proceeds typically are not subject to tax. Now, if there's an interest component, that could be taxable. But again, if you're the beneficiary and these proceeds are being paid to you like every month or once a year for 10 years, then that could be subject to tax. Now, this is one of these ones that you don't want to bank on for retirement income, but if you happen to get it, this is, a little nice, I guess, benefit. The fourth one is municipal bond income, or muni bonds, right? So you may have heard of the term muni bond income. So typically you kind of buy these bonds. I think they start out at, I think it's like $5,000 or so. And the interest income that, that grows, right? So you put in $5,000, it grows by another $1,000. That $1,000 is not subject to tax. So this might be a nice, little investment strategy if you have a lot of cash and trying to figure out where to kind of put it all. I think right now, muni bonds aren't a bad place right now to invest. Now, at the state level, similar to inheritances, they might have like a different tax treatment. So you want to make sure how taxes are treated for at the state level. And the last one most of you should know is Roth IRA withdrawals. These are great retirement advantaged accounts. you put in, $5,000, $6,000 per year, and, the amount that it grows beyond the 6,000 per year, once you reach the age of 59 and a half and you take that money out, like all of it's not subject to tax, which is a great strategy. And I'll probably cover this in another video, is kind of like Roth IRA conversions, like what those are, why do it, when to do it. But we're seeing a lot of people kind of take that approach too, especially, one thing you want to look for is when you do that conversion, most of the time, those conversions could be taxable. So you want to make sure your tax bracket is at a lower level in the year that you do it, because there's going to be less tax you're going to have to pay on that conversion. So that's the fifth type. So if you have any questions, leave them in the comments below. Thanks again for watching the video. And if you haven't subscribed, please do so. I'm trying to get a video out every week. If there's topics you want to hear, also let me know. I'm trying to cover, taxes, financial planning, those type of areas. Thanks.